using SSAS as part of a business exit strategy. SSAS, small self-administered scheme, is always established, usually by a limited company, and always really for the directors of that limited company. So the SSAS should have become, over the years, hopefully you've had one for a while, or perhaps you're looking to take one out, should really become an integral part of your long-term business strategy, because the SSAS probably should have been one of the primary ways that you are taking money out of your limited company in a highly tax efficient way by making contributions for yourself and possibly your fellow directors as well. This obviously helps to reduce the amount of corporation tax that you're paying on an annual basis. And obviously that would undoubtedly be seen as a prudent and sensible business strategy, and certainly by anybody potentially looking to buy your business. I think it would go towards definitely demonstrating that you are running your business in a highly tax efficient and prudent manner, in addition to probably what you do on a normal day-to-day basis. It's also worth saying that usually when calculating the value of a business, quite often known as EBITDA, if you do make pension contributions from the company, this should not detract from the value of your company, because pension contributions are normally added back to your profit to demonstrate the gross profit of your company. It's very much something that your accountant will be able to help you with. They're fully experienced usually in advising their business owners on how to maximize the value of their business, what EBITDA is in a bit more detail, and they'll be very familiar with you making pension contributions. SSAS should have been a way that you have built up long-term wealth to support your exit, hopefully in addition to the very large check somebody's going to give you for your business, and allow you to sail off into the sunset and go and do the things you've always wanted to do. Another aspect that we come across regularly when people are looking to exit business is actually looking at the assets on the balance sheet. Quite a lot of business sales that we've seen over the years, you tend to find a lot of buyers just want to buy, say, the goodwill, but not necessarily the fixed assets in the business. And by this, I'm generally referring to commercial property. So if you've had commercial property on the balance sheet of your company now, or have had for a while, you again may want to have a chat with us and your accountant about the SSAS potentially acquiring that commercial property from your company. If we acquire the property off the company, so therefore take it out of your balance sheet, again, I don't think that should impact too much on the sale value of your company, because potentially if they're looking at the goodwill, they won't want to potentially buy the fixed assets, as I've said. SSAS acquiring the property is always a very good move from a number of tax reasons. Takes it off the balance sheet, protects it from creditors, and also the rent coming in would then be gross, no income tax, no CGT. But if you've put the property into the SSAS, there's a good chance that the people wishing to acquire your business may not want the fixed asset, as we said, but they may want to continue to use the commercial premises that you're running the business from. We've had a number of cases of these over the years where the SSAS has been holding the commercial property from which the business trades. They've had a trade sale. The new owners have decided not to take on the property and would rather rent. So again, this could potentially provide you with a very nice tax-free income stream into the pension from the new tenants of the property. You sell the business, the people buying your business take on the lease of the property, and they pay you rent into your SSAS. Providing you're of retirement age, you could be then drawing that rental income out as your pension income, and some of it may of course be subject to income tax at your highest marginal rate. So certainly taking the fixed assets off the balance sheet can be a huge positive when looking at the business sale. With regards to forward planning, my experience with most business sales is they can take up to 3 years before they come to fruition, and there's often a lot of legal toing and froing, as I'm sure if you speak to your accountants, they will let you know. So if you are thinking about a business sale, it's good to start planning this at least 3 to 5 years ahead of when you want to do it. And if you have got those fixed assets on the balance sheet, come and talk to us at One Crown Pensions, and we can look at, can we acquire in particular that commercial property for you, take it off the balance sheet, and that just may make your company all the more saleable.
Book a call with us via the link in the description below. If on a mobile device, simply hit the More button under the video title and pick a convenient time to speak. Feel free to share this video with others that may benefit on WhatsApp or in other online groups or channels. Like, subscribe and hit the notification bell for lots more SaaS related content, and leave a comment if you found this video helpful. For more, visit onecrownpensions.com.